Imagine waking up tomorrow morning. You check your investment account, and before you've answered a single email, before you've gone to work, before you've traded another hour of your life for money, you see another dividend payment. Then another, and another. By the end of the month, your investments have produced enough cash to cover your rent, your food, your utilities, your insurance, your everyday expenses. Let's say that number is $5,100 per month. That's $61,200 per year. Not from a business you have to manage every day, not from overtime, not from a second job, but from owning assets that distribute cash to you. For many people, this is the dream behind dividend investing. The idea of reaching a point where your money begins paying for your life. But there's one question that usually gets skipped. How much money do you actually need? And more importantly, what is the fastest, realistic path to get there? Because there is a huge difference between chasing the highest dividend yield and building a portfolio that can actually support you for decades. A stock paying a 10% dividend might look like the fastest road to financial freedom.
But sometimes that high yield exists for a reason. The company could be struggling, the stock price could be collapsing, and the dividend you're counting on could disappear. So the fastest way to live off dividends is not necessarily finding the highest paying stock. It's building a system that combines income, growth, consistency, and time. In this video, we're going to break down what it could realistically take to generate $5,100 per month in dividend income. We'll look at the portfolio size required, the different dividend yields that could get you there, the fastest way to accelerate the process, why reinvesting dividends can completely change the timeline, and why trying to reach financial freedom too quickly can sometimes set you back by years. This is not about getting rich overnight. It's about understanding the math. Because once you understand the math, the dream becomes a target, and a target can become a plan. Let's start with a number. $5,100 per month. That's the target. Multiply that by 12. You need $61,200 per year in dividend income. Now here is where dividend investing becomes very simple. Your annual dividend income depends on two things: the amount of money you have invested and the average dividend yield your portfolio produces. The basic formula looks like this: portfolio value times dividend yield equals annual dividend income. So if your portfolio produced an average dividend yield of 3%, you would need about $2.04 million invested to generate $61,200 per year. At a 4% yield, you would need approximately $1.53 million. At a 5% yield, about $1.224 million. And at an 8% yield, the number drops to around $765,000. At first, the 8% portfolio sounds like the obvious winner. Why spend more than $2 million building a 3% portfolio when you could theoretically produce the same income with less than $800,000? This is where investors can get trapped, because yield is only one part of the equation. A dividend portfolio is not a savings account. The companies inside the portfolio can grow or shrink. Their stock prices can rise or fall, and dividends can increase, stay flat, or get cut. So the goal isn't simply to build the portfolio with the highest yield. The goal is to build the portfolio that can continue paying you, not just this year, but potentially 10, 20, or 30 years from now. And that changes everything. Imagine two different investors. The first investor finds a stock with a 10% dividend yield. That sounds incredible. They invest $100,000 and expect to receive $10,000 every year. But there's a problem. The company is struggling. Revenue is declining. Debt is increasing. The stock price begins falling. Eventually, management decides the dividend is too expensive to maintain. The dividend gets cut in half. Suddenly, that 10% yield becomes 5%, and the investment itself may now be worth significantly less than the original $100,000. The second investor chooses companies with lower yields. Maybe 2.5%, maybe 3%, maybe 4%. At first, the income looks disappointing. But the companies are growing. Their earnings are growing. And over time, their dividends increase. A dividend payment that started at $1 per share becomes $1.10, then $1.25, then $1.50. Years later, the investor may be earning a much higher income from the same original investment. This is one of the most important ideas in dividend investing. The dividend you receive today is not necessarily the dividend you receive in the future. A strong dividend portfolio can grow its income. That means the fastest path may not come from maximizing yield today, it may come from balancing current income with future dividend growth. Because a portfolio producing 3.5% today with growing dividends can potentially become far more powerful than a portfolio producing 8% today with a declining business behind it. The number you see on the screen today is only part of the story. The real question is, what will that income look like 5 years from now? So what is the fastest, realistic way to reach $5,100 per month? The answer usually comes down to 3 engines working together. Engine number 1, your contributions. Engine number 2, investment growth. And engine number 3, dividend reinvestment. Most people focus almost entirely on the third one. They imagine buying dividend stocks, waiting, and eventually living off the income. But in the beginning, dividends are usually the smallest engine. Your own contributions matter much more. Let's imagine you invest $500 per month. That's $6,000 per year. Even if you receive a 4% dividend yield, your first year of dividends might only produce a relatively small amount of income. But now imagine increasing that contribution, $1,000 per month, then $2,000, then more as your income grows. The early years of dividend investing are often less about passive income and more about building the machine. You're feeding capital into the portfolio. Every contribution buys more assets. More assets can produce more dividends. Those dividends buy even more assets. And eventually, the process begins accelerating. This is the moment when compound growth starts becoming visible. In the beginning, it feels slow, almost disappointingly slow. You may invest for years and still not generate enough dividends to pay for a single major expense. But eventually, the numbers begin stacking. A portfolio paying $100 per month becomes $200, then $400, then $800, then $1,500. And the higher the income becomes, the more powerful reinvesting becomes. The fastest realistic strategy is often surprisingly simple. Invest aggressively, diversify, reinvest, increase contributions whenever possible, and give the system time to compound. There is no secret dividend stock that can replace those fundamentals. Let's look at what happens when dividends are reinvested. Imagine a portfolio worth $500,000. The portfolio generates a 4% dividend yield. That produces $20,000 per year, or roughly $1,667 per month. Now, imagine you don't spend that income. Instead, you reinvest every dollar. Those dividends purchase additional shares. Those additional shares generate additional dividends, and those dividends purchase even more shares. The portfolio begins creating its own growth engine. This is the part of dividend investing that can feel almost invisible in the beginning. The first few years may not look dramatic, but over longer periods, the difference between spending dividends and reinvesting them can become enormous. Think of it this way.
Every dividend payment gives you a choice. You can consume the cash today, or use that cash to purchase another small piece of the income-producing machine. In the accumulation phase, the goal is often to grow the machine, because once you finally reach the $5,100 monthly target, the situation changes. The portfolio has reached a new purpose. Now the income may be used to support your life. And that's when dividends stop being numbers on a screen. They become groceries, rent, travel, bills, time.
Now, let's return to the central question. How much money might you need to generate $5,100 per month? There is no single answer, because it depends on your portfolio yield. Here's a simplified example. At a 3% yield, you need approximately $2.04 million. At 4%, approximately $1.53 million. At 5%, approximately $1.224 million. At 6%, approximately $1.02 million. And at 8%, around $765,000. But these numbers should not automatically make higher yields look better. A portfolio yielding 6% may carry different risks than a portfolio yielding 3%. Higher yield investments can sometimes involve more volatility, more debt, slower growth, or a greater chance that distributions could change. This is why the fastest path is not simply a mathematical race toward the highest percentage. A sustainable dividend strategy asks a different question. Can the income survive? Can the companies continue producing cash? Can they continue paying shareholders? Can the dividend grow over time? And can the portfolio survive recessions, market crashes, and unexpected economic changes? Because financial freedom doesn't mean reaching $5,100 per month once. The real goal is reaching it and continuing to receive it. There is a point in the journey where things begin changing faster. At first, nearly all portfolio growth comes from you. You are doing the heavy lifting. You earn money. You save money. You invest money. But eventually, the portfolio begins contributing more to its own growth. Imagine you are investing $2,000 every month. That's $24,000 per year. In the beginning, that contribution might be much larger than your annual dividends. But years later, your portfolio could potentially generate $20,000, $30,000, or even more in annual dividend income, depending on its size, yield, and performance. Now something interesting happens. Your investments begin contributing almost as much as you do. Eventually, the portfolio can begin generating more income than you are adding. This is where the journey can feel like it accelerates. But getting to this point requires surviving the slow phase, the phase where nothing feels exciting, the phase where your dividend income is only enough to buy lunch, then groceries, then pay one utility bill, then cover multiple expenses. The people who eventually reach financial independence often spend years building before the results become visible. The finished portfolio gets attention. The years of accumulation usually don't. But those quiet years are where the financial freedom is actually built. So if the goal is to eventually generate $5,100 per month from dividends, the roadmap could look something like this. First, define the income target. For this example, $61,200 per year. Second, choose a realistic portfolio yield. Instead of automatically chasing the highest number, consider the balance between income, growth, diversification, and risk. Third, calculate the portfolio target. For example, at a 4% average yield, approximately $1.53 million. Fourth, focus heavily on contributions during the early years. Your savings rate can have an enormous impact on how quickly you build the portfolio. Fifth, reinvest dividends during the accumulation phase. Every dividend can purchase more income-producing assets. Sixth,
Allow the income to grow. The goal is not simply to collect dividends. The goal is to build a portfolio capable of producing more income over time. And finally, when the portfolio reaches the level where it can reasonably support your lifestyle, the dividends can begin doing what they were originally designed to do: support your life.
The numbers may seem large, but financial independence rarely arrives all at once. It arrives in pieces. The first bill your investments pay. The first month your dividends cover your groceries. The first year your portfolio generates more income than you expected. And eventually, the moment you realize that the money you invested years ago is now helping pay for the life you're living today. And that is when a dividend portfolio becomes more than an investment. It becomes a source of income, a source of flexibility, and potentially a way to own more of your time. Note, this video is for educational and informational purposes only and is not financial advice. Dividend payments, yields, stock prices, and investment returns can change, and dividends are not guaranteed.
Living off dividends sounds like a finish line. $5,100 arriving every month, whether you work or not, whether you take a vacation, whether you spend the day doing absolutely nothing. But the real journey begins much earlier, with the first investment, the first dividend, the first $10, the first $100, the first month where your portfolio pays for something that used to come entirely from your paycheck.
Then the process continues. More capital, more shares, more dividends, more reinvestment. And eventually, the small payments begin turning into something larger. The fastest way to live off dividends is rarely about finding one perfect stock. It's about building a system where every dollar has a job. Your contributions build the foundation. Your investments provide growth. Your dividends create cash flow. And time allows all three to work together. For a $5,100 monthly dividend income target, the portfolio required could range from hundreds of thousands of dollars to several million, depending heavily on the yield and the sustainability of that income.